The structural financing of metropolitan transit infrastructure is undergoing a fundamental yet largely invisible shift. Traditional public funding mechanisms are facing unprecedented fiscal strain, and in this void, highly sophisticated legal maneuvers are being deployed. We're initiating a forensic financial analysis of urban transit privatization. We'll examine the precise mechanisms of asset recycling, sovereign debt, algorithmic extraction, and the opposing blueprints for the future of our municipalities. Your morning commute is no longer just a public service. It has become a high-yield asset for the world's most powerful institutional syndicates. While you swipe your fare card, shadow investors are using complex financial models to quietly seize control of the very tracks beneath your feet. The illusion of absolute public ownership is fading. What we are exposing here is the exact financial playbook that converts municipal debt into private collateral, permanently stripping public assets into the hands of private holding companies without a single public vote.
Section 1. Anatomy of the debt trap.
Historically, the municipal bond market served as the primary vehicle for public works, providing local governments with low-cost, tax-exempt debt. But as legacy infrastructure deteriorates and economic crises compound, that traditional model is fracturing. It creates a massive opening for aggressive institutional capital. The result? Look at this number, $50 billion. That represents the outstanding debt load of the New York Metropolitan Transportation Authority alone. Compounded by pandemic-related revenue losses exceeding $20 billion, the agency is essentially paralyzed. And because the MTA is governed by state laws and bond covenants that explicitly prohibit bankruptcy, it can't simply restructure its obligations through the courts. This massive, unpayable debt load forces extractive solutions, compelling municipalities to seek immediate capital injections at literally any long-term cost.
The core engine of this strategy is a mechanism known as asset recycling. In this model, financially desperate cities trade their future, predictable farebox revenue streams in exchange for immediate, massive cash injections from private investors. The municipality gets a temporary budgetary band-aid, but in return, the private syndicate secures decades of guaranteed yield. The infrastructure itself becomes a secondary concern. The primary objective is pure, calculated financial extraction. The architecture of this equity swap relies heavily on public-private partnerships, or P3s. Direct municipal borrowing relies on tax-exempt bonds with lower interest rates. P3 payments, however, are effectively an off-book form of debt. Private capital inherently demands significantly higher interest rates, and it's usually paid back over a much longer term. Furthermore, these long-term contracts fundamentally reduce the long-term financial flexibility of the municipality, all while legally locking in investor returns. The consequences of shielding these liabilities from immediate public view are severe. Consider the chilling evidence of a recent accounting shift in the United Kingdom. When off-book P3 liabilities were finally brought transparently onto public sector balance sheets, it triggered a massive debt bomb. The total sum amounted to over £300 billion. That equates to almost 20,000 Canadian dollars in hidden liability per UK family. That is the staggering hidden cost of trading long-term civic assets for short-term fiscal relief.
Section 2. Algorithmic fares and biometric harvesting.
Once private control is secured, the mandate to maximize shareholder profit necessitates high-velocity extraction strategies. The traditional flat fare, long a staple of equitable public access, is being systematically replaced by algorithmic pricing models. Similar to rideshare applications, these algorithms are built to maximize profit through brutal surge pricing during peak morning and evening congestion hours. The working professional, who has a captive schedule and no real alternative but to travel during these peak times, is algorithmically squeezed for every possible fraction of a dollar. But physical transit revenue is only half the equation. Commuter data is the new, completely unregulated frontier. By March 2025, the Osaka Metro in Japan is implementing facial recognition ticket gates across 97% of its stations. This is chilling evidence of physical infrastructure converging permanently with digital tracking and mass surveillance. Your facial recognition data, your daily commuting patterns, and your precise location history are continuously collected. This results in an absolute loss of biometric sovereignty. Your user data is harvested, packaged, and sold to third-party data brokers, quietly becoming a highly profitable secondary revenue stream for transit holding companies. Under this model, you're no longer just a passenger, you are a highly valuable data point to be monetized.
Section 3. The rise of transit deserts.
We must now analyze the spatial and social fallout that occurs when municipal transit is treated strictly as a profit-maximizing asset rather than a foundational public good. When return on investment dictates planning, we see the deliberate creation of transit deserts.
Look at the Greater Toronto and Hamilton area. Unprofitable routes servicing vulnerable or lower-income neighborhoods are systematically severed. The populations that rely on these routes the most are intentionally stranded, completely disconnected from the economic lifeblood of the city.
What we are left with is a stark, dystopian contrast in urban development, a phenomenon known as splintering urbanism. Sleek, automated, premium transit corridors are developed explicitly for affluent choice riders. Meanwhile, captive riders are left shivering in decaying, abandoned infrastructure.
The allocation of transit services between rich and poor is not happenstance, but is directly connected to social and economic polarization. This assessment from transit equity researchers Garrett and Taylor summarizes the reality precisely. Transit inequity is not a byproduct of bad luck. It is a structural, systemic inequity engineered directly into the blueprints of our urban spaces.
The data from Rio de Janeiro provides an unflinching case study of this polarization. The 2014 World Cup and 2016 Olympics drove massive public investments in rail and bus rapid transit. However, quantitative analysis reveals these high-profile infrastructure expansions disproportionately benefited wealthier groups. Then, when the 2017 economic crisis hit, severe reductions in regular bus services immediately followed, absolutely devastating accessibility for the city's most vulnerable lower-income populations.
Section 4. Blueprints for civic sovereignty. The analytical mind doesn't simply observe a crisis. It identifies the underlying mechanisms and evaluates the proposed solutions. So we'll conduct a strictly impartial analysis of the two primary diverging models proposed to resolve this municipal transit crisis. On one side, the public common partnership model advocates for democratic co-ownership, where generated surpluses are legally bound to fund the local commons, prioritizing transit equity. On the opposing side, the free market privatized automation model relies on private equity management, where surpluses flow directly to shareholders, with an absolute focus on aggressive operating cost reduction. Let's first examine the structural mechanics of the democratic approach. Under the Union Street Public Common Partnership model, local infrastructure is legally ring-fenced. Through the use of community benefit societies and specialized land banks, the function of acquiring assets is strictly separated from the democratic process of deciding their use. This is designed to ensure that economic wealth remains localized and compounds within the community itself. A critical mechanism within this framework is non-extractive digital land value capture. It works like this. When transit infrastructure is upgraded, surrounding property values naturally increase. Instead of allowing developers to absorb this windfall, AI-driven mechanisms calculate and capture the generated land appreciation. This revenue is then legally bound to self-sustaining civic trusts to fund adjacent commons-based infrastructure and biophilic planning. Conversely, we must examine the mechanics of the free market approach as outlined by institutions like the Reason Foundation. This model argues that federal labor protections, specifically Section 13C, artificially inflate operating costs by locking in outdated labor practices and blocking innovation. Their data suggests that by repealing these labor laws, deploying full autonomous automation, and utilizing competitive private contracting, transit agencies could slash their operating costs by up to 46%, resolving the fiscal deficit without the need for massive public tax bailouts.
The mathematical trajectory of our infrastructure is set, but the governance model remains deeply contested. As legacy transit systems collapse under the weight of insurmountable debt, the resulting vacuum will be filled. So, who will ultimately own the ground beneath your feet? A democratic civic trust engineered for local equity, or the perfectly optimized extraction algorithms of shadow investors? Equip your mind with the hard data, master the architecture of these financial maneuvers, and demand absolute transparency in how your city is funded.